European banks have bought massive amounts of government bonds this year, totaling around 200 billion just since January. At the same time, while loans are up, they aren't up by nearly as much, despite the fact that the ECB has cut rates and really market interest rates have been going lower since last year. So why are European banks loading up on government bonds and not lending into a real economy that's supposed to be responding to all of this quote unquote stimulus? And the disparity is even worse when you consider that banks had only around 1.6 trillion in government bonds back in January. So adding 200 billion more, some of that's market value in the market value increase, but adding 200 billion more is a tremendous 1/8 increase in the size of government bond holdings among European banks. At the same time, it doesn't sound like the banking system is preparing for a robust recovery because then they would be lending. So what they're really doing is continuing to seek the safety and liquidity of government bonds while only just a little bit of a margin error fluctuation in actual loans and lending. It tells you everything you need to know about, first of all, rate cuts, but also the economic background, which means that the rate cuts are responding to the same things that European banks are. And if European banks are doing this, you know that they're not alone. Not only are other banks around the world and financial firms and everyone else in the real economy thinking the same way, there are also negative impacts from European banks becoming defensive. As I mentioned in a recent video, European banks have been redistributing dollars in a huge way since 2022. So if they're becoming more defensive, we're starting to explain why the US dollar is rising and why everyone around the world is becoming increasingly defensive, at least outside of the mainstream media. So let's bring in Steve Van Metre here. What do you make of European banks and the fact that they're loading up, backing up the truck for government bonds at the same time? They're like, yeah, we'll give out a few loans to maybe some of our best customers, but we're not lending any more beyond that.
Yeah, Jeff, just like you kind of said, it's not just European banks, it's Chinese banks as well, despite the fact that Beijing is just not happy about that. The question is, why are banks buying bonds? Because a lot of people think, well, that doesn't make any sense. Don't they realize that interest rates are going to go up and the economy's going to boom? But that's not what it's about. The banks are saying, hey, wait a minute, when we lend money, our number one goal, and a lot of people don't realize this, when you lend money, the first thing and the only thing you care about is getting that money back. In a booming economy, you don't worry about that too much. Someone goes out and buys a new car, they sell it in 3 years, and a new loan pays off that original loan, and you just keep the cycle going because the economy's booming. But in a weakening economy, what happens is the system starts to run out of money, consumers get cash strapped, and then next thing you know, they start getting behind on their payments. And eventually, if it goes on long enough, they enter a default position. That's not what the banks want. So in this case, Jeff, you're right. They're only willing to lend to their best customers. Why? Because they know they have the money. That's always the case. You think about it at the corporate level. If Apple wants to borrow money, well, anybody will lend it to them. But you take some small business who's struggling, no one wants to lend them money. It all makes perfect sense. The banks here are realizing that if they lend money, they might not get it back. But guess what? If they go out and buy government bonds, you know what they're guaranteed to get? That's the coupon.
Yeah, you know, the funny thing, I was just going to say, Steve, their best customers are sovereign governments in Europe, right? That's what they're really saying is like, we'll lend to, Germany and France, even though the economies in both places are increasingly concerning, if not alarming. But we don't, major companies, we're not going to lend to households, we're not going to lend to business. In fact, the statistics that came out for the month of October from the ECB showed exactly that. There's a very tiny, small fluctuation in an increase in loans. But it's been that way over the last year or so. Basically, European lending has been flat to the real economy going back to 2022, which is exactly what you're talking about. European banks look at the situation and say, yeah, no thanks. We'd rather not do that. And then the added bonus of lending to sovereign governments is the fact that the securities that come back in that lending process are highly liquid. So they're sticking to government lending or buying sovereign bonds because it gives them the perfect degree of safety from both credit risk, which, as you said, is not there. The coupons are going to happen anyway, as well as liquidity risk, which means if the European bank gets into a, God forbid, some type of liquidity squeeze from some other part of the financial system, they can immediately sell or use the government bond that they have in inventory as collateral to borrow funds. So basically what we're saying is they're becoming defensive in every possible way that they can, despite the fact that it's supposed to be going the opposite direction for Europe and the rest of the world. This is a globally synchronized action that says, I mean, you pointed out China, there's others too. US banks are doing the same thing. They're getting increasingly defensive because there's every reason to get defensive, right?
Absolutely, Jeff. And last week we did see from the U.S. banks some lending coming after the election. But if we look at the year-over-year rate of change in just commercial industrial lending, it's like low single digits, somewhere between like 1% and 3%. It's nothing to get excited about. So you look at it from the U.S. perspective. What are we hearing from Federal Reserve reports? They're saying consumers are increasingly delinquent. Banks are not wanting to lend. Financial standards are tightening. And all that means for people that don't understand what we're talking about is when you go into a bank and you say, I'd like to borrow money, and they say no, well, that means standards have gotten tighter. They make it more difficult. Before, you used to go and say, well, here's a few things. And now they're saying, well, you need more than a few things to prove it to us. Because again, it all comes back to when banks lend, they want to get their money back. So as you said, Jeff, they're lending to the government because they know they're going to get their money back. In worst case, like you said, the instruments are highly liquid. They could always lend against them, use them as collateral, or even in a QE situation, which I know we've talked about in the past, and I've made very clear. There will be QE again. I don't know when, but it's coming back.
Yeah, the when is always the question. It's hard to tell that ahead of time, but that's exactly what the banks are thinking too. We don't know when either, so we're not going to wait around to find out. You mentioned, standards of credit lending are tightening substantially in the United States too. The New York Fed's report on the household survey of credit, what is it, SCE, where they said not only are we got delinquencies rising, but the key takeaway I took from that was the rejection rate. And it was a rejection rate on every class of lending, whether it be auto loans, which ticked up, I think it was 11% rejection rate, which is absolutely not astronomically high, but also mortgages. Because the mortgage cycle in the United States, mortgages have been completely cleaned up since the last financial crisis, not financial crisis, but the last mortgage crisis and housing bust. The banking system will not lend on mortgages to basically anyone but the best possible borrowers. And so there is very low delinquency rates in U.S. mortgages up for the last decade or so. They've gotten lower and lower and lower. They've started to tick up a little bit. They're very low to begin with. But now banks are saying we're rejecting mortgage applications, which someone needs to tell Jay Powell, because if interest rate cuts are supposed to work in the U.S., they have to work where banks are going to want to give out more loans, not less. So this is another angle on interest rate cuts and how they don't actually work the way people think they don't work as easy as it's made out to be, because there's all sorts of complications, starting with banks that become defensive when conditions turn in this direction. I mean, they stop lending to a lot of the people who need to get loans in order for the economy to continue to moving forward.
Jeff, what I find interesting about the rejection rate in real estate loans, there's a couple of things that I find it very interesting. Is first of all, we've seen a lot of people get really bullish, at least on the equity side of the market, on builders and commodities, thinking there's going to be a real estate boom. But again, it comes back to the banks. If banks aren't going to lend to people to buy a home, well, you can't have a boom. It's not possible. And I know some people say, well, there's a lot of cash buyers. Of course there's cash buyers, but there aren't enough cash buyers. But let's talk about the kind of the other factor here, because you said the rejection rate is across the board. And we know that consumers are in delinquency, and we know that rate's increasing. We know the labor market is getting a lot weaker. We saw continued claims break over 1.9 million. We know that hours worked are going to get cut. We've seen retailers say, hey, we're not that confident of Black Friday. So you look at this from the consumer's perspective. They need money and they need access to it right now. So what's the one place consumers have money? Well, it's their home. So what I found even more interesting is the rejection rate for refinances. Now, you would think, who would want to refinance if you've got a 3% mortgage at prevailing rates? Well, if you don't have money, you go to where you've got the ATM machine, you go to the house. And I want to say the rejection rate on that was like over 20%. I don't remember what it was, Jeff, but I remember looking at that being, that's really shockingly high. And I couldn't figure it out at first, and then it hit me. It's the only place people have equity. They need it, and the banks are saying no.
Yeah, it was like 26%. I think it was like 26.1, which was shockingly high. Because like I said, the mortgage business has been completely cleaned up over the last decade or so. In fact, it's too cleaned up. The banks have not been giving out enough mortgages to build enough houses in this country. So you would think that they would say, okay, I don't want to lend to consumers on credit cards because that's, I mean, cyclical, everything there. We've seen delinquencies really rise in credit cards. All the banks have said that. They said credit card delinquencies are really rising. But they could, okay, I don't want to lend on credit cards. I don't want to lend on autos. But what about mortgages? Mortgage business is incredibly safe. It seems like that would be a no-brainer. But instead, they went the other way and said, we don't want to lend on credit cards. We don't want to lend on autos. But we don't want to lend on refis even more, yes, I had the same reaction you did, Steve. Like, wait a minute, what's going on here? So you put all these signals together. You've got European banks that are saying, we want to buy tons of government bonds. And you've got European banks saying, I don't want to lend into the real economy. And you've got American banks that are buying some bonds too. And they're also saying, we're rejecting more loan applications than we have since like 2010 or 2011. And you start to get a sense that the banking system is looking at the global situation locally from a local perspective and thinking, I think I need to take some steps to really clean up my act here and make sure that I have the backstop that I need so that I don't run into major problems if this cycle really does continue to go in the direction that it really appears to be going.
Yeah, because Jeff, what the banks are telling us about the housing market, despite popular belief that housing prices are going to rise and always rise and will continue to rise along with demand, is they're saying, wait a minute, if I'm not willing to refi you, and we know that they don't refi 100% of the value of the house. So even at say 80% value, the banks are saying, we're not convinced that you're going to make the payment or that there's enough value in your house later on if you go into default that we can kick you out and sell it and get our money back. That's what they're trying to tell us here is they see the economy turning down. Now you kind of wonder, maybe people will say, well, why would the banks do this? But you got to go back to the last financial crisis and who was at the center of it? It was the banks. And what was the risk? That perhaps the government would take them over, there'd be consolidation, and the banks don't want this. The executives, the shareholders, they make so much money at these banks, they don't want that to happen. So what do you do to keep yourself out the limelight and you know the economy's heading to recession? Well, you start preparing for the hurricane weeks ahead of everybody else. And that's what they're doing here because they don't want, particularly in a new administration, who may come in and say, hey, look, you guys screwed up again? Well, I'll just nationalize you. They don't want that.
Yeah, you mentioned that. I think that the consideration here is one of the lessons they learned from the last crisis was that they don't want to foreclose either. So even if they don't care about the value of the property, what they're really looking at is incomes. They're saying, look, I see your application. I see everything that you're trying to document your income. And I don't even want to take the chance that I have to foreclose on this loan because it is a nightmare. It's even more of a nightmare nowadays than it was a long time ago because, again, we've learned a lot of lessons since then. So banks are really looking. That's why refi rejection is like auto loans and credit cards because it's really about incomes and cyclical considerations. They don't even care about the value of houses because I don't want to foreclose on a house. I don't want to do anything like that. So I think that's what really stood out from the rest of the credit reports, the rejection rate on refis. And then, of course, as you're saying, Steve, what's the other side of that? Now you have consumers who are, okay, they're struggling. They're already falling behind because of the purchasing power that they lost over the last several years. That's always been the background to begin with. Now the labor market gets weak. Their jobs not as solid as they were before. Maybe they're losing hours. Paychecks aren't growing in the way they need to because prices are still going up. And so it's like, what do? You get to the end of the line. Savings are gone. We keep hearing that. Pandemic savings are completely exhausted. And so the last resort for a lot of people is, well, I've got some equity in my house. I can just turn that into a credit card because the local banker will be only too happy to give me a loan, especially as interest rates are going down, right? Rates are going down, so it'll be cheaper for me to do this, to liquidate the equity in my home and liquidize it and make it useful. And the banks are suddenly saying, nope, well, you can't even get in the door unless you're a top quality borrower. And if you're a top quality borrower, your chances are you don't need to go there to begin with. It's a real big problem from both sides of the ledger.
Yeah. So Jeff, what we're seeing from the banks is they're just echoing, like you said, the slowdown in income growth, but they're really talking about the labor market. I mean, we go to China. We know the banks are buying bonds there, but what about the labor market? Youth unemployment is at staggeringly high levels. Kids are graduating college, no opportunities for work. What about those who do have jobs in the manufacturing sector? Well, they're facing deflation, and we know that means demand's going down, and that means eventually jobs are going to get cut. We turn to Europe, same thing happening. Banks are buying bonds, but what's going on there? The German manufacturing sector is in practically, I would say a depression given the state of their automobile market. And based on all the data we're hearing, that's not going to get any better. So you're seeing the same thing there. The banks are going into a risk off mode. And then you turn to the US. Unemployment claims, we're seeing continued claims. Again, 1.9 million and rising when everybody said that was going to go down. The banks are looking at this saying the economy is going in the wrong direction.
What you're saying, Steve, is globally synchronized, right? I mean, that's what it comes down to, is that we see the same types of behavior in one place and then another. I mean, China, Europe, and the United States, the three largest economy that accounts for more than half of global GDP, and the banking sectors within those economies are doing basically the same things at the same time. It's something that you need to really stop and pay attention to. So the banking system, it's not just Europe, it's not just China. And I mean, China's a really big one as well. I mean, I know the 10-year treasury in China just on Friday got down to another record low. This is despite the fact that Beijing is going all in, at least they're appearing to go all in on their stimulus. We're bailing out local governments. We're going to recapitalize the banks. And the banks are saying, great, give me some more government debt. I'll take that. It's one after another. And it gets to be the timing, everything, the consistent behavior. It gets to be one of those things where you look at and say, okay, you can't just continue to ignore this as just, okay, it's Europe's problem or it's China's problem. There's this idea that the US in particular is going to decouple from the rest of the world. And we hear this decoupling idea come about every couple of years. Every time we go through these globally synchronized downturns, decoupling always comes up and it never actually happens.
Jeff, and you're right, it doesn't happen, but this time we're even more coupled together. I mean, again, we go back to China because this is hilarious. Banks are buying the long bond that the government is issuing, and then the government gets upset. Wait a minute, why are you guys buying the long bonds instead of lending?
Stop buying our bonds. That's right. That's what they say. Yeah. Stop buying our bonds.
Right. Stop buying it. So we're going to buy those off of you and put short-term debt so you'll lend against it. It just shows the state of their economy. You turn, of course, back again to Europe. You see the same effects. What are we hearing from people about the ECB? Oh, where they're going to cut rates until production increases. Well, if that's the case, they got to cut rates a massive amount. And then you get to the US and you start to see some of these Fed speakers slipping. And Goolsbee comes to mind, recently said, oh, rates are going to go down and a lot. And you start like, why are we hearing this out of China? Why are you hearing this out of Europe? And why would Goolsbee be saying that when he should be saying, no, we're going to decouple. Things are great. What's going on elsewhere is not going to affect us. No, what he knows is where they go, we're going to follow.
Yeah, and that's the reason why we're following the banking sector is because the banking sector has more information and more access to information that tells us a little bit, not a whole lot, but a little bit, maybe enough that when they're turning defensive, it's one of those things. It's not, they don't bet everything on what the banking sector does, but it's a good place to start. If they start becoming increasingly more visibly defensive, that's one of those things you say, okay, what's really going on here? And if it was just Europe, okay, Europe's in trouble. We know that. If it was just China, China's in trouble. We know that, but it's the same type of behavior across the entire globe. And we see the same type of behavior from the other side in terms of consumer spending and business sentiment and everything else. It all points to, including central banks increasingly desperate to cut rates, it all points to the global cycle continues to move in the wrong direction.
Right, Jeff. And you look at like the combination here, because it's not just banks buying bonds, there's a combination of them buying bonds against high rejection rates and weaker lending. When you put that together, you know what the banks are worried about. They know that the economy around the world is getting a whole lot worse.